We are looking at double entry for assets. What are assets? Remember your properties, remember your belongings, remember your resources, remember those things that you will say are your what? Belongings. Now, as a business, there are items referred to as assets. We're going to be looking at the double entry for the assets. Now, assets are the resources owned and utilized by an organization for generating more wealth or resources. We can as well say assets are business or personal possessions or belongings or resources. What I am trying to say is those items of value that belonged to an individual or belonged to an organization is what we refer to as an asset. Now, having understand that assets are the resources or the belongings of a business, we can classify assets into two: tangible assets and intangible assets. Tangible assets are assets of the business that can be seen or touched. I'll say that again. Tangible assets are the assets of the business or the resources of the business or the belongings of the business that can be seen or touched. Now, tangible assets are divided into current assets and non-current assets. I just told you that the tangible asset is divided into what? Current assets and non-current assets. Now, what makes an asset current? Current assets are the assets or the business resources or the business belongings that are in the form of cash or are easily transformed into cash within the usual course of what? Business. Usually, in an accounting year, an accounting year is like a 12-month calendar as adopted by any business organization. It can be January to December. It can be February to the 12th month of the following year. But that is a decision of the organization. But those assets that are easily transformed into cash within that period of accounting year in the course of what? Of doing business as usual, it's what we call what? Current what? Asset. Take for instance, the cash you have at bank. Take for instance, the cash you have in the office. Take for instance, the petty cash balance in the office. Take for instance, debtors. Debtors are individuals or organizations that are owing what? A business organization. For instance, if someone is owing you 1 million naira, for instance, that person is referred to as a debtor to you. So to your business, that person is a debtor. And that value is referred to as a current what? Asset. Because in the ordinary course of business, that amount of debt is expected to be recouped within the shortest possible period of what? Of time. Another example of current assets are inventories. Take, for instance, goods purchased and kept in the warehouse. It's a current asset. So any item that behaves in this manner is referred to as what? A current what? Assets. Now, I also told you that another division of what? Of tangible asset is what? The non-current assets. Now, the non-current assets are the business assets or the business resources that are permanent in nature or are not easily transformed into what? Cash in the usual course of what? Business. The non-current assets are also referred to as the business resources or business belongings that are utilized by the business over a long period of what? Time. For instance, the motor vehicle owned by the business, the building owned by the business, the land owned by the business, the machineries owned by the business, the tools owned by the business, furniture owned by the business. These are what? Non-current what? Assets, because they are usually utilized by the business over a long period of what? Time, and are not easily transformed or are not of the nature of what? Being transformed into cash within the what? Ordinary course of what? Business. And as such, we say they are what? Permanent in what? Nature and utilized over a long period of what? Time. Usually, it is referred to as what? As fixed assets by our local standard. But after the adjustment of the standards, that's not a topic for today, fixed assets are now commonly referred to as non-current assets. Now, recall we classified assets as tangible and what? Intangible. Now we have defined tangible assets, and then we divided tangible assets into what? Current and non-current. Now another classification of asset is what? The intangible what? Assets. The intangible assets are the business resources or the business belongings that are valuable but cannot be seen or touched. Now, intangible assets are recognized or brought into book as a result of the peculiar nature of the transaction. Take, for instance, money spent on acquiring what? Patent what? Right for a new what? Invention. If such a cost is significant, such that it cannot be written off at once, it is now gradually written off over what? A long period of what? Time. As a result, it becomes an asset in the book, but it is what? An intangible what? Asset. Another example is what we call goodwill. Now, goodwill is also an intangible what? Value of what? Of a business recognized as a result of various factors, such as what? Experience, such as impressive market share. Usually, this goodwill is recognized during business acquisitions, and then such value is recognized as as an asset, but it is intangible. Now, to make it easy, any asset or resource that is that cannot be touched or seen, but has a quantifiable value, is referred to as intangible assets. Now we have been able to define assets and classify assets into tangible and intangible. But assets can also have other nomenclatures depending on the user of the reports, and also depending on the industry. So let's look at some of those nomenclatures. Here we have toxic assets or high risk assets. Now, an asset is said to be toxic or of high risk when there is a tendency of such asset to negatively affect the profit or bottom line of the business. Take, for instance, a loan given to staff members. Okay, now when you give a loan to staff members, they are seen as debtors to the business. And then there's this possibility of losing the staff before the loan is paid back. Now, if we lose or we lost that staff before the loan is paid back, there's the tendency that the company or the business loses the unpaid part of that loan. That kind of scenario, we can refer to that type of debt or that type of assets. Remember, debtors are assets, as a toxic asset or a high risk asset. Sometimes business also sell on credit. Now, if you sell on credit to an individual, that person becomes a debtor. But if that credit is significant and unsecured, say for instance, credit sales without bank guarantee, there's a tendency of that credit sales resulting into bad debt, and as such it will affect the bottom line of the business. Such kind of scenario, we refer to those kind of assets that as toxic assets or high risk assets. Now, low risk assets are assets owned by the business with minimal possibility of negatively affecting the profit or bottom line. For instance, loan given out to staff members or other business organization with some sort of security. We sell on credit, there's the possibility of not getting paid. So what do? We get a bank guarantee to secure it. That lowers the risk. So when there is an asset that has high tendency of negatively affecting our profit, it becomes, or it is referred to as a toxic asset or a high risk asset. But when there is an asset that has a minimal possibility of affecting the profit or bottom line of the business, we refer to it as what? Low risk what? Assets. Now, another nomenclature I think we should look at is what we call the fictitious what? Assets. Usually we also refer to it as what? As unreal assets. They are assets recognized as a matter of policy or standards, but are untrue in the real face of it. Now we are recognizing them as assets because of what? The nature it takes due to what? Policy or what? Or standards. But in the real face of it, it is what? Unreal. Take for instance, in an accounting year of 12 months, we budgeted to sell up to the tune of 12 million. Now, but because it is a business that is what? Just starting, there's a need to invest in what? In advertisement. And then advertisement cost alone is about 50% of what? Of the sales for the year, due to what? The market penetration we want to achieve. Now remember, there are other costs associated to what? To the business. Now, if advertisement is taking 50% of the total sales and there are other costs, it becomes a matter of standard of policy, to write off what? All the what? Advertisement costs at the same time, or what? Write them off what? Gradually. Now, where it is decided that what? The advertisement cost should be written off what? Gradually, the part here to be written off is usually what? Recognized as what? As an asset in the book. Such assets are what? Are unreal in the what? In the face of it. So we refer to them as what? As fictitious what? Assets. So technically, or in a simple form, when a cost item takes the nature of what? Of an asset, okay, it becomes what? Fictitious. So once the asset is in the book and it cannot be physically traced, it can also be called what? Fictitious what? Assets. Now, we understand what an asset means. Generally, assets are what? The business resources, the business belongings, that are utilized to generate more wealth. We also said it can be referred to as what? The business owned what? Properties, and then we also classify them into what? Tangible and intangible. So whichever way it is, whether tangible, whether intangible, current, non-current, fictitious, the double entry application for assets is dependent on whether the asset is increasing or decreasing. Now, when we say asset increasing in value, we mean additional to what we already have. For instance, you have one vehicle. You bought another vehicle. The cost of vehicle in the business will increase by the new one that has been what? Purchased. So when assets increase in value, the double entry application is what? Is for what? Is a what? Is a debit. So what am I saying? What I'm saying is when assets increase in value, they are debited. So if we have an additional furniture, an additional building, an additional equipment, an additional cash, an additional debtor, those are increase in values. They are what? Debited. Now, where there is what? a decrease in the value of the assets, they are what? Credited. What am I saying? Assume we have 3 vehicles in the business and 1 is sold. It means that what? Vehicle will reduce from what? 3 to what? 2. So in that case, what happens? The vehicle account is what? Is credited. So where there is a decrease in the value of an asset, be it cash in hand, be it cash at bank, be it equipment, be it vehicle, be it tools, be it furniture, so long as the value is decreasing, it takes a credit what? Entry. Now here is a simple diagram illustrating the double entry application for what? Assets. Now these are your assets. It could be cash, it could be bank, debtors, motor vehicle, equipment, inventories, whatever assets. It can either increase or what? Decrease in value. Where it increases in value, you debit. Where it decreases in value, you what? Credit. Now with the understanding that our assets can either what? Increase or decrease, and with the understanding that when the asset increases you debit and when it decreases you credit, we're going to identify what? The asset items in these transactions, and then put the item that increases in the right column and the one that decreases in the right what? Column. So with this understanding, in our class of illustration, it will be easy, to comprehend why an asset item is debited or an asset item is what? Credited. So let's quickly take this. The first one there said cash paid to bank from the office. Remember, I told you that we have cash in the office and cash at bank. So when we hear cash, we're talking about the cash in the office. When you hear bank, we're talking about cash at what? Bank. So in this transaction, there are 2 asset items. Cash in hand and cash at what? Bank. Now, which one is increasing and which one is decreasing? So for you to interpret it, you must know the movement. We are paying cash to bank from the office. So it means that what? The cash in the office is what? Decreasing, while the cash in the bank is what? Increasing. So item increasing here is what? Bank. Item decreasing here is what? Cash. Why? Because cash in the office will decrease and the cash in the bank will what? Increase. The next one I said bought equipment by check. So there are 2 items here, equipment and check. But because check goes to the bank, what we recognize it as what? Bank. So that means there are 2 items, equipment and what? Bank. Now, which is increasing and which is what? Decreasing. When you buy equipment, that means you have more equipment. So equipment is what? Increasing. Then the money in the bank is what? Decreasing. So equipment is the what? Increasing ledger item here, while bank is the decreasing ledger item. So the next one said paid for tools in cash. So if you're paying for tools, it means you're having more tools. And you're paying it in cash, that means cash is reducing. So our tools here is the ledger item increasing. Cash here is the ledger item what? Decreasing. Then we have sold some tools for cash. Now if you sell tools, that means the tools will decrease. And then cash here, when you sell it, you receive cash. Cash will what? Increase. So the increasing ledger item here is cash. Decreasing ledger item here is what? Tools. The next one I said withdrew some cash from bank for office use. So you're taking money from the bank and putting it in the cash in the office. So the money in the bank will decrease, and then the money in the office, that's the cash in the office, what will increase. So the increasing ledger item here is cash. The decreasing ledger item here is what? Bank. The next one, bought furniture by check. Remember, when you buy furniture, you have more furniture. So that means furniture will increase in value. Then bank here, money check goes to the bank. Bank here, the cash in the bank will what? Will reduce. So the increasing ledger item here, asset item is furniture. Decreasing asset item here is what? Bank. The last one said receive cash from Mr. Ben for debt owed the business. So if you're receiving cash from Mr. Ben, it means that what Mr. Ben is owing you will decrease, and then the cash you have will what? Increase. So the cash, the ledger item increasing here is cash, and the ledger item decreasing here is Mr. Ben, the what? Debtor. Now, we have been able to demystify or simplify double entry application for assets. We were able to understand that assets are what? The resources or the belongings of what? A business utilized to generate what? More wealth. And then we're able to classify assets into two: tangible assets and intangible assets. We explained that tangible assets are assets that can be seen or touched, and then tangible assets is divided into what? Current assets and non-current assets. I also explained that what current assets are assets that are in the form of cash or can be transformed into cash in the course of what? Business as usual. Usually within the accounting year. I give examples: cash in hand, cash at bank, debtors, inventories. And then I said non-current assets are assets that are permanent in nature or are not easily transformed into cash in the course of what? Business. And then I said by a local standard, we refer to them as what? As fixed what? Assets. I gave examples: land, building, I said furniture, equipment. These are all examples of what? Non-current what? Asset, also referred to as what? Fixed what? Assets. I also told you that based on industry or usage of the reports by various stakeholders, that we can have some nomenclatures for assets. I told you that we can have assets referred to as toxic, where there's high tendency of negatively affecting the bottom line of the business, as the profit of the business. That's, we call it high risk assets. Then we can have low risk assets that has minimal possibility of affecting the bottom line negatively. I give examples. I say, for instance, if you're selling on credit, without securing the credit, it is possible to lose that money, and that will affect the profit of the business. So such is called toxic asset when it is not secured. When it is secured to some extent, it becomes low risk asset. I talked about fictitious assets that are unreal in the face of it, but are recognized as a matter of policy or standard. And then I talked about an asset either increasing in value or decreasing in value. I said when assets increase in value, they are debited. When they decrease in value, they are credited. And now that's the summary of the class. So I will encourage you to pick up transactions, identify the assets in them, see if they are increasing in value or decreasing in value. If you have if you have questions for clarifications, you can reach me on 081-36506-356 or send me an email, jeremiah.dosu@gmail.com.